Hi there, it's Friday the 29th of November 2019. I'm Steve Towers. Welcome to ITB. Let's get started. Well, last week's public consultation meeting on Pillar 1 was interesting. Let me give you my top 8 takeaways from the meeting, in no particular order. Firstly, mandatory binding arbitration is a major conflict area. Multinationals want mandatory binding arbitration, but developing countries don't. Interestingly, Grace Perez-Navarro from the OECD said, "We are working towards something other than mandatory binding arbitration that would have an equivalent effect." The second point is that industry scope is another major conflict area. A number of multinationals argue that their particular industry should be carved out of Pillar 1, but developing countries and civil society groups argue that the unified approach's focus on consumer-facing businesses is too narrow. B2B businesses should be included. Third, a one-stop shop approach for tax administration in regard to Amount A should be adopted, with the group parent company responsible for the calculations and the tax authorities in the group parent company's residence jurisdiction responsible for reviewing the calculations. Fourth, the likely revenue impact of Pillar 1 is a key factor in determining whether a consensus will emerge. No official information has yet been publicly provided on the likely revenue impact, but a number of commentators have suggested that there will be minimal impact, which might prevent any consensus. Fifth, the interactions between amounts A, B, and C need to be clearly identified to ensure there's no double counting. And related to that point, number 6, there needs to be clarity on where Amount A is taken from. In other words, which pool of profits in which jurisdiction is the source of Amount A, again to avoid double counting. 7. The repeal of digital services taxes should be a quid pro quo for the adoption of the unified approach. And 8. Different speeds are advocated. Many multinationals support a go slow approach to ensure that the design features are properly drafted. However, those multinationals which are or will be exposed to digital services taxes argue in favour of a speedy resolution in order to get the DSTs repealed. You can watch a video of both days of the public consultation meeting on the OECD website. For the relevant link, please go to our website or app. As a reminder, in regard to Pillar 2, next Monday, the 2nd of December, is the deadline for written comments, and the public consultation meeting will be on the following Monday, the 9th of December. For information on these two items, please go to our website or app. And Bruno Le Maire, France's finance minister, has stated his government's support for both Pillar 1 and Pillar 2, and has suggested that the minimum tax rate under Pillar 2 should be 12.5%, which will make Ireland happy. And speaking of France, the US Trade Representative has issued a statement that its Section 301 report on France's 3% digital services tax will be released on Monday. For a copy of the statement, please go to our website or app. Meanwhile, Turkey's 7.5% DST has been passed by Parliament. It will enter into force on the first day of the third month following the date on which the law is published in the official Gazette. The 1st of January 2020 will be an important date for the MLI. For those double tax treaties which are covered by the MLI and where the MLI has entered into force for both contracting jurisdictions, the 1st of January 2020 will be a major start date for the MLI to apply for withholding tax purposes. And for many of those treaties, that means the start of the Principal Purposes Test, the PPT. As a reminder, Article 35(1) of the MLI sets out the general rules for the entry into effect of the MLI. As you can see, paragraph A applies to withholding taxes imposed on non-residents. Under paragraph A, the date of entry into effect will be the 1st of January on which or after the MLI has entered into force for both contracting jurisdictions. Let me give you these examples. As you can see, in 3 of the examples, numbers 1, 2 and 5, the 1st of January 2020 will be the date of entry into effect for withholding tax purposes. Please hit the pause button if you'd like to study these examples. For many of these treaties, Article 7(1) of the MLI, the PPT provision, will be relevant. And a critical point to note with the PPT is that there is no grandfathering. So that means that for those treaties where the MLI will enter into effect for withholding tax purposes on the 1st of January 2020, avoiding the application of the PPT will be necessary in order to claim a treaty-based lower withholding tax as from that date, even for existing structures and transactions. The OECD has released the 7th batch of peer review reports on BEPS Action 14 concerning the MAP process. The 7th batch covers 7 jurisdictions: Brazil, Bulgaria, China, Hong Kong, Indonesia, Russia and Saudi Arabia. For a copy of the 7 peer review reports, please go to our website or app. And the OECD this week hosted the 10th anniversary meeting of the Global Forum on Transparency and Exchange of Information for Tax Purposes. You can watch a video of the meeting on the OECD website. For the relevant link, please go to our website or app. In Australia, the tax authorities have issued for public comment draft guidance on the income tax treatment of salary and wages and other labour costs. In particular, the guidance focuses on the treatment of labour costs which are related to the construction or creation of tangible or intangible capital assets. According to the guidance, such labour costs are capital in nature and therefore they don't qualify for immediate deduction. The guidance doesn't deal with the question of whether such labour costs can qualify for tax depreciation or other capital allowances. Public comments are requested by the 14th of February. For a copy of this draft guidance, please go to our website or app. Also in Australia, the tax authorities have released the final version of guidance in regard to cross-border related party derivatives. The guidance, which was released in draft form in August 2018, sets out the ATO's views on tax compliance risks in regard to this topic. For a copy of the guidance, please go to our website or app. And finally, in Australia, the tax authorities have filed an appeal against the recent Federal Court transfer pricing decision concerning Glencore, but only after they obtained special permission to do so after they missed the filing deadline by 6 minutes. Can you believe that? In China, the Ministry of Finance has released Announcement 91 of 2019, which deals with the eligibility requirements for the R&D VAT refund scheme. For a copy of this announcement, please go to our website or app. Also in China, the government has released for public comment a draft of the new VAT law. Public comments are requested before the 26th of December. For a copy of the draft, please go to our website or app. In India, the government has introduced into Parliament a bill to implement the corporate tax rate reductions, which were announced by the government on the 20th of September. At that time, Parliament was not sitting, and therefore the government implemented the changes through an ordinance. The current bill aims to replace the ordinance and put the changes on a permanent footing. In doing so, the bill makes some further amendments. For a copy of the bill, please go to our website or app. In Indonesia, the finance minister has been reported as saying that the bill for the proposed tax reforms will be introduced into Parliament next month. According to the reported statement of the finance minister, the key elements of the proposed tax reforms are, firstly, a reduction in the general corporate income tax rate, which is currently 25%, to 22% in 2021 and then to 20% in 2023. Secondly, a reduction in the special corporate income tax rate applicable to certain publicly listed companies, which is currently 20%, to 19% in 2021 and then to 17% in 2023. Thirdly, imposition of VAT on inbound digital services. And finally, introduction of a significant economic presence rule to determine taxable presence for corporate income tax purposes. In Singapore, the tax authorities have issued updated guidance on the GST treatment of e-commerce transactions in regard to physical goods and digital services. For a copy of the updated guidance, please go to our website or app. In Sri Lanka, the new government has announced a number of tax law changes. In particular, the standard rate of VAT will be reduced from 15% to 8%, effective on Sunday, the 1st of December, with the exception of financial services, where the rate will stay at 15%, and the 2% nation building tax will be abolished. In Taiwan, the Ministry of Finance has released guidance in regard to so-called one-time transfer pricing adjustments. For a copy of the guidance, please go to our website or app. In the EU, the Council has adopted a directive on new company law rules which will facilitate cross-border conversions, mergers and divisions. Member states will have 36 months to transpose the directive into national law. For a copy of the directive, please go to our website or app. The European Commission has released its November infringements package with quite a few taxation items. For the third and highest level of infringement, referral to the European Court of Justice, there's one item. For the second level of infringement, the issue of a reasoned opinion, or in two cases, the issue of an additional reasoned opinion, there are 8 items. Please hit the pause button if you'd like to study this list. The item in regard to Denmark concerns its failure so far to amend its law in response to the Fidelity Fund's case in 2018. And for the first and lowest level of infringement, a letter of formal notice, there are 2 items, both concerning Romania. For a copy of the November infringements package, please go to our website or app. And finally, in the EU, the Competitiveness Council failed in its meeting yesterday to approve the proposal for public CBC reporting. The proposal was defeated by member states which are opposed to dealing with this issue other than as a taxation issue, which requires unanimous support. Guernsey, Jersey and the Isle of Man, 3 British Crown dependencies, have jointly issued updated guidance on their economic substance legislation. You'll remember that they jointly issued the original guidance early this year. For a copy of the updated guidance, please go to our website or app. Italy will become the latest EU member state to introduce a lottery scheme to encourage consumers to insist on receiving VAT cash register receipts. Under the plan, which will be effective the 1st of January 2020, cash registers will be required to produce receipts with a unique code, which will then be entered into a regular prize lottery. This type of plan has been implemented in several other EU member states. In Poland, the government has decided to defer the reintroduction of the retail sales tax to the 1st of July 2020. You'll remember that Poland was successful early this year in its litigation with the European Commission in regard to the EU state aid impact of the retail sales tax. In Romania, the new Prime Minister has stated that he wants to abolish the financial assets tax, commonly referred to as the greed tax. However, he leads a minority government, so we'll see what happens. In Spain, the Supreme Court has decided a free movement of capital case in regard to dividends paid to a US regulated investment company. You'll remember that I covered a similar case decided by the European Court of Justice in ITB 2 weeks ago. The US RIC owned shares in Spanish companies. The Spanish companies paid dividends to the US RIC and deducted 15% dividend withholding tax in accordance with the Spain-US Treaty. The US RIC argued that the imposition of the 15% dividend withholding tax breached the free movement of capital, which is required by Article 63 of the Treaty on the Functioning of the European Union. For that purpose, it argued that its position should be compared with a hypothetical Spanish UCITS fund holding shares in Spanish companies. A 1% dividend withholding tax would apply on dividends paid to a Spanish UCITS fund. Therefore, the US RIC claimed a refund for the 14% differential in withholding tax rates. The Supreme Court agreed that a hypothetical Spanish UCITS fund is the correct comparison, even though a non-EU fund cannot qualify as a UCITS fund. The court held that a US RIC operates under an equivalent regulatory framework in the US. The court also considered whether there was an effective information exchange mechanism between Spain and the US, which would enable the Spanish tax authorities to verify the necessary information. This issue was relevant because if there was not an effective information exchange mechanism, that could justify the higher rate of withholding tax on the basis of prevention of tax evasion and avoidance. However, the court held that yes, Article 27 of the Spain-US Treaty does provide an effective information exchange mechanism. And so the court decided the case in favour of the US RIC. One Spanish newspaper has suggested that this decision could expose the Spanish tax authorities to total refunds for non-EU funds exceeding 10 billion euros. For a copy of this case, please go to our website or app. In the UK, the upper tribunal has decided a VAT case in regard to loan administration services provided by the taxpayer to a bank. The issue in the case was whether the services were covered by Article 135(1)(d) of the EU VAT Directive and were therefore exempt from VAT. The tribunal held that the services did not fall within that provision, and therefore the services were subject to standard rate VAT. For a copy of this case, please go to our website or app. In South Africa, the tax court has decided a VAT case concerning the possible retrospective operation of an apportionment provision. Section 17 of South Africa's VAT legislation deals with the apportionment of dual-purpose expenses in order to determine the proportion of the expenses which will secure input tax credits. The provision requires that a taxpayer use an apportionment method which is approved by the tax authorities. Only one method has been pre-approved by a binding public ruling, a turnover-based method under which apportionment is based on the value of receipts from taxable supplies as a percentage of total receipts. Section 17 permits a taxpayer to use an alternative method, provided the alternative method has been approved by the tax authorities. And in fact, the binding public ruling requires that an alternative method be used if the turnover-based method is not fair and reasonable or appropriate. However, under Section 17, the approval by the tax authorities to use an alternative method is effective only for the tax year in which the approval is given and in future tax years. It is not effective for previous tax years. In this case, the taxpayer used an alternative method for several tax years before seeking and obtaining approval from the tax authorities to do so. In granting that approval, the tax authorities accepted, and indeed the court accepted, that the turnover-based method in the circumstances of the taxpayer was not fair and reasonable and not appropriate. Nevertheless, the court held that Section 17 was clear. For the previous tax years, the taxpayer must use the turnover-based method. For a copy of this case, please go to our website or app. In Chile, the tax authorities have released a redacted private ruling in regard to the definition of royalties in the Chile-UK Treaty. The ruling states that a UK resident company, in exchange for a certain amount, will acquire from a Chilean mining company the right to receive, for 15 years, a percentage of the net product of the foundry. The issue considered in the ruling was whether the payments received each year by the UK company would be covered by the business profits article or by the royalties article. Here is the definition of royalties in Article 12.3 of the treaty. The relevant parts are highlighted. Payments of any kind received as a consideration for the use of or the right to use any other intangible property. As you know, that phrase, other intangible property, is not found in the corresponding definitions in the OECD and UN model treaties. The ruling states that the contractual right obtained by the UK company is intangible property, and it therefore concludes that the payments received by the UK company qualify as royalties. I must say that I have some difficulties with that conclusion. Firstly, by tagging the phrase or other intangible property onto the list of patents, trademarks, etc., suggests that the iusdem generis interpretation principle should be adopted. And secondly, it doesn't seem appropriate to describe the payments received by the UK company as being for the use of or the right to use its contractual right. And in case you're wondering, the treaty was signed in both the English and Spanish languages, with both texts being equally authoritative. For a copy of this ruling, please go to our website or app. Also in Chile, the tax authorities have issued guidance on the income tax treatment of cross-border reorganizations which involve at least one entity incorporated in Chile. For a copy of this guidance, please go to our website or app. In the US, the Court of Appeals for the Fifth Circuit has decided a case concerning a claim for a bad debt deduction in regard to a payment made by a parent company to its insolvent foreign subsidiary. The court held that the payment should be characterised as a contribution to capital and not as a debt. Accordingly, the parent company was not entitled to a bad debt deduction. For a copy of this case, please go to our website or app. And now for this week's treaty developments. We've had 3 treaties signed and an exchange of notes enter into force. And in addition, Luxembourg has announced that the most favoured nation clause in its treaty with Lithuania has been triggered, effective the 1st of January 2019. The MFN clause relates to Article 12 on royalties. According to the announcement, the source country tax rate limit is now nil, and the definition of royalties is now effectively the same as in the 2017 OECD Model Treaty. I have 3 articles for you this week. I have grouped the first and second articles together because the topics are similar and they have a common author. The 2 articles are a new global tax deal for the digital age and a unified approach to international tax consensus. The first is written by Alison Christians and Tarcisio Dines Megalis and is available on the SSRN website. And the second is written by Alison Christians and is published in Tax Notes Today International. If you'd like to obtain a copy of the first article, you can do so at our website or app. Both articles are critical of the current direction of Pillar 1 of the Inclusive Frameworks Digitalisation Project, on the basis that it will not result in an outcome which will be materially beneficial to most developing countries. Let me quote from the abstract of the first article. The OECD is currently in the midst of a project intended to tackle the tax challenges arising from the digitalisation of the economy. As laid out in Pillar 1 of its program of work released in May 2019, the goal seemed broadly to develop consensus on a new taxing right to allow countries to tax multinationals even in the absence of traditional physical presence. Upon inspection, the plan seems to be about rebalancing taxing rights among the relatively affluent OECD member states, plus a few other key non-OECD states. Viewed from this perspective, the urgent effort to forge a new global tax deal for the digital age is destined to forestall a much-needed discussion on the broader distributive implications of the current global tax deal. This article therefore critically examines the emerging tax bargain. The article concludes with a prediction that on its current trajectory, the program of work on digitalisation is likely to produce a new global tax deal that looks much like the old global tax deal, with a relatively modest redistribution of taxing rights among a few key states, thus missing an opportunity for meaningful reform. The second article is particularly critical of the way in which the OECD Secretariat's unified approach for Pillar 1 has narrowed the discussion. It should come as no surprise then that a big move of the Secretariat's proposal is to definitively cut off discussion around the only proposal from the earlier consultation draft that represented the preferences of non-EU, non-US powers, namely the G24's Significant Economic Presence proposal. Spearheaded by India, that proposal would have required global consensus on a full redesign of the international tax bargain from separate entity to a unitary approach. That is, a wholly unified approach to the taxation of international capital flows. Whether that is a good idea or not is unexamined. After a brief moment in the spotlight of Pillar 1 in the work program released in May, by October the proposal was not to be discussed further. Only the identified point of contention, that is, the extent to which mainly European states may be allowed to tax the profits of mainly US market monopolizing digital companies, is considered critically important to the OECD, and it commands maximum attention from policy leaders and experts. And you might be interested to know that a summary version of the second article was posted by Alison Christians in the blog on the International Centre for Tax and Development's website. And shortly thereafter, a rebuttal was posted in the blog by an OECD official. For the link to the blog, please go to our website or app. And the third article is called The DAX 6 Intermediary, Multiplying Compliance Costs and Creating Loopholes. It's written by Martin Weyers and is published in the Clua International Tax blog. The article considers the intermediary definition in the DAX 6 mandatory disclosure regime for reportable cross-border arrangements, which will generally apply in EU member states from the 1st of July 2020. It focuses on the broadening of the intermediary definition in the final directive, which was adopted in 2018, compared with the corresponding definition in the European Commission's original proposal in 2017. It argues that the broadening of the definition will likely lead to both over-disclosure and, paradoxically, under-disclosure. The author gives this example of under-reporting. US promoter A designs and implements a cross-border arrangement for German taxpayer X. The arrangement concerns the purchase and sale of a hard-to-value intangible between X and associated enterprise Y, while the purchase price remains outstanding. The interest on the outstanding amount is deductible in Germany, but remains untaxed because Y is not resident for tax purposes in any tax jurisdiction. The only other person involved in the implementation of the arrangement is German consultant B, who is in charge of the valuation of the intangible. This cross-border arrangement is reportable under Hallmark E2, an arrangement involving the transfer of a hard-to-value intangible, and C1A, an arrangement involving deductible cross-border payments between associated enterprises if the recipient is resident in a zero or almost zero tax jurisdiction. The tax authorities will be interested in both the transfer of the intangible and the existence of a mismatch in the interest payment between X and Y. Promoter A has all relevant information in his possession, but is located outside of the EU and thus not considered an intermediary under DAX 6. Consultant B is not a promoter, but qualifies as intermediary if he knows or could be reasonably expected to know that he has undertaken to provide advice with respect to the implementation of a reportable cross-border arrangement. Consultant B is aware that he is advising on the transfer of a hard-to-value intangible between associated enterprises X and Y, which triggers Hallmark E2. He is therefore considered an intermediary and has to provide the information within his knowledge, possession, or control. Because he has no knowledge of the tax aspects of the transaction, that information will most likely be limited to the identification of A, X, and Y, and some information on Hallmark E2. German taxpayer X is not required to disclose any additional information because a reporting intermediary is involved, consultant B. As a result, the relevant information on Hallmark C1A goes unreported. Taking into account the large number of expected and more detailed disclosures in other cases, the chances of the tax authorities carrying out a tax audit on this disclosure may be considered small. Well, that's the way it is this Friday, the 29th of November, 2019. I'm Steve Towers. Have a great weekend.